All right, hello everyone. We have a special guest this time around on our channel, Michael Wang, who is a founder of Prometheus, a new kind of app for financial professional financial professionals and such that I've been using and love, and we'll talk more about that in time. But Michael, welcome to the show. You've got an interesting background. We'd like to get your perspective on things, and just welcome. How's it going?
Good. Thank you guys for having me on. It's an honor and a pleasure to be here.
Good. Yeah, Matt and I were interviewed on your platform is sort of a content provider, sort of like a mix of, I would say, like a Twitter and financial hedge fund managers and financial influencers and the like, and institutional investors kind of meet up on this platform, right? You want to tell us a little bit about what it is real quick before we kind of go into stuff?
Yeah, sure. So Prometheus is a platform. I would put it in a nutshell. It's a social marketplace for investing, and I could tackle that in a couple of different pieces. On the marketplace front, we're trying to accomplish two things there. One, democratize access to hedge funds, venture funds, crypto funds, real estate funds, et cetera. And then number two is we're going to massively expand the total addressable market of the entire alts industry, which today is roughly 14 trillion of assets across hedge funds, PE, VC, but it's entirely owned by large institutions and large family offices. Now, many of these institutions are already 40 to 50% penetrated in their portfolios in alts, not much penetration left to go in the institutional realm. But high net worth capital globally, plus retail as well, is a much, much larger market in the hundreds of trillions of dollars with very low penetration in alts. And that's that white space that we want to tackle in the marketplace. So think of the marketplace as Robinhood, but instead of coming here to buy and sell stocks, you come here to shop for hedge funds, venture funds, crypto funds, et cetera. And then how the social piece fits into it, and you alluded to this earlier on the content side, we have a big social and content engine. And how that fits into the equation is that think of it almost like Facebook or Instagram, but built from the perspective of fund managers, allocators, buy side, sell side, et cetera. So it's a forum where professional managers can actually feel comfortable posting content, whether it's talking through an investment idea, it's talking through their views of the macro or their investment process, whatever content that they want to put on in whatever medium, whether it's text-based, linked to an article, charts, or video. They could do so on Prometheus and do so comfortably, because most managers on Wall Street, they don't really post on Twitter, TikTok, Wall Street Bets, stock tweets, etc. No. And quite frankly, part of the reason why, and I could tell you from personal experience when I was running Cypress, the last hedge fund I was running, there's no way in heck I ain't going to post, my views of the stock market on TikTok. Next to a 12-year-old girl lip syncing Billie Eilish. That's not the right platform for me as a professional. So we wanted to build something a bit more refined on the social front, meant for the needs of these professionals, and allow the public, for the first time ever, to interact and engage and learn directly from the pros. You go on stock twits, or you go on Twitter or Wall Street Bets, you're generally getting insights from somebody who's anonymous, likely some 19-year-old kid who just learned how to invest.
The Wild West out there,
Yeah, exactly. Whereas when you come on Prometheus, and by the way, it's a totally free platform for anybody to join. Yeah. You come on Prometheus, you get to engage and learn directly from some of the best investors in the world, these fund managers. So
it's really a great platform. I mean, Emmet and I think, have been pretty vocal in how much we've learned from some of the accounts on Twitter. But I would say, there's quite a bit of curation that kind of goes into finding the right accounts, the people who actually know what they're talking about, instead of, just kind of posting whatever crazy, like I've seen charts of technical analysis that uses dogs and memes and all this crazy stuff. And obviously on Prometheus, there's none of that. So it seems like the signal to noise ratio of Prometheus is a lot better than what you find on Twitter.
Exactly. And extraordinarily high. What we wanted to do was eliminate a lot of that noise. So for instance, we're all fans of Tesla, I think, in this room. I know you guys own a heck of a lot of Tesla. Yeah. I also am a Tesla bull as well. But if Tesla is down 7% today, I want to know why it's down 7%. Literally, if we pull up Twitter or Wall Street Bets right now, type in $TSLA, what do you get? You You get a bunch of noise, Now, there's a lot of great material on these sites and a lot of good analysis, It takes a while to be able to filter through the noise to get to that analysis. So if I type in right now, most of the time I see some sort of meme, of rocket ships and moons and stuff like that. It doesn't give me any insight on why Tesla's down 7% or whether I should be buying or not, Whereas you come on Prometheus, you may hear from, some of the top 10 shareholders of Tesla. You may hear from people like Kathy Wood and stuff like that. So that's the utility.
Yeah, you guys have a really great network you're building out there. Like, the network effects of Twitter is monstrous, first mover advantage, and a lot of this information stuff. But there's a lot of noise. The signal to noise ratio is not ideal. Obviously, you have to really figure it out for yourself in a lot of ways. But you guys do a lot of vetting to make sure people are who they say they are. For example, I don't think there's any anonymous accounts on your platform, right?
No. And that's one way we help eliminate the noise from the get-go, which is that we require people's full names.
I like that.
Whereas obviously on Twitter and Wall Street Bets and stock twits, they're anonymous. So you don't really know who's posting, Yeah. By the way, we love Twitter and we encourage our members to continue tweeting. For instance, Kyle Bass, he does a lot on Twitter, continue tweeting that. But also obviously have a presence on Prometheus. We want to connect with some of these other platforms. But unlike Twitter, we're solely dedicated to that silo of business, finance, and investing. Whereas Twitter, you're posting alongside a celebrity, a 12-year-old, a housewife, soccer player, et cetera, across millions and millions of topics, right? We are just dedicated to essentially one silo of finance and investing. Yeah.
And I guess the way that your business makes money is not through advertising either, right? Which is nice. Twitter, you're just bombarded with ads. And at this point, at least, I think, at least when I'm using your platform, I don't see any advertising, which is nice. And it's more like you're just trying to build the content engine, the platform, and I think your goal is to sort of make money by actually connecting the actual investors with the emerging managers and such. Is that right? Like through the platform, if they discover each other on the platform, then there's a small kind of fee. You guys get a piece of that, and that's how your money is going to be generated. Your revenue.
Yeah. So there's a couple monetization models. We're not going to do advertising on the social right now. We're more focused on building up that community, and we don't want to dilute that experience by having a lot of advertisements. We may do advertisements later on, though, but certainly not now. The monetization models will break up between the marketplace and the social. On the marketplace side, it's a success-based commission. So if an investor invests through the Prometheus platform in, let's say, hedge fund XYZ, the investor pays whatever the hedge fund's fees are. Let's say it's 2% management fee, 20% of performance fee, and they don't pay anything extra on top of that for Prometheus. So they don't pay anything to Prometheus. We take our cut from the actual managers. So it's success-based commission, for the managers. The managers love it because it doesn't cost them anything to join. It's risk-free, and it's essentially found money for them. And they just, pay a commission to the marketplace. On the social side, again, this platform's free. You can create an account in 10 seconds or less. We integrate with Apple ID, Google ID, et cetera, and start engaging, learning from these pros, ask questions, et cetera. All that stuff is free. We'll likely be spinning up premium subscriptions later on. And what those premium subscriptions will entail is it will allow the user to get access to exclusive events. So, for instance, weekly Q&A calls with a different, pro,
Great. And so one last thing about Prometheus before we kind of move on to other stuff. So far, it's like an infomercial for your business, which is great.
No.
I love your business.
I love this already. Definitely my time.
I'm genuinely curious, though. I'm not trying, is Prometheus, like if you think about this, you go to sleep thinking it's your baby here. So where do you see it, best case scenario, 5 or 10 years from now? Like, what do you think its role is in the world 5 or 10 years from now? What's best case? Like, what's your dream?
Yep. I would say let's start with the mission. Okay, the mission is really empowering, people, all sorts of people, not just rich people, but all sorts of people. With number one, empowering them with the right financial knowledge, financial literacy directly from the pros. And then number two is giving people access to these funds that they've never had access to before. So we'll start with those two missions, and everything really revolves around that, those two concepts. And what I want this to be in 5 years is the central place that everybody goes to, whether you're a 20-year-old Robinhood trader to large institutional asset allocator. It's a central place that people go to engage with each other about investing and sharing that investment knowledge. One problem in the traditional hedge fund industry and private equity industry is that there's been no transparency to the outside world. This is why we have this Main Street versus Wall Street phenomenon going on, is because, quite frankly, it's our fault in the industry. We've offered zero transparency to the world, so people can think however they want about these hedge fund managers. Most managers are not Stevie Cohen or Ken Griffin at Citadel, right? That is the exception by far. That is not the rule. Most managers are running, a couple $100 million, maybe, and struggling to try to stay alive, quite frankly. We want to help those managers build their exposure, build their brand, build a following, and build assets. We want to level the playing field and allowing these managers to build their own brand through their content, and allowing people to get to know them through their content, right? Because investors I guess they technically invest in a fund, but they're really investing in the manager, right? And you got to build trust in the manager, and we want that great experience to allow investors to build trust in the manager through content on the platform. So number one, central place where people come to for credible investment insights. And then number two is I want this the place for people to come to access alternatives of all types. Whether it's an NFT manager or a crypto manager or a long-short equity hedge fund manager, this is that central place where people go to and institutions go to transact. We're totally modernizing the whole way that people transact, because currently it's rife with so much friction. If I want to invest in a hedge fund, I got to fill out a 90-page subscription document. Now, if I want to invest in 10 different hedge funds, I got to fill out the same information 10 different times. We've totally streamlined that process with using software and AI to be able to auto-populate these subdocs, so that the user, all he has to do after filling out one master subdoc is just DocuSign going forward in future transactions and wiring the money. And so
great.
Our industry, the alts industry, very archaic when it comes to technology. We just want to modernize some of this technology.
Yeah.
Now, you mentioned kind of the importance of opening the door to alts to a lot of investors who typically haven't had access to it. Why is that kind of an important mission to you? And what do you think is available in the alt space that maybe most typical investors aren't getting in their 401k plan or their IRAs, or why alts versus other investment kind of asset classes?
Yeah. What I would say is if I would look at myself, I have assets across all different asset classes, from cash in the bank to real estate to my own interactive brokers, public equities portfolio, to private investments, to investments in many other alternative funds, and that's just part of my portfolio. And I have access to all these different asset classes, but most people don't have access to all these different asset classes, right? They have access to, public equities via their Robinhood account, perhaps, maybe they have money in their house, and that's pretty much it. We're just offering an additional asset class for people, and it's a phenomenal asset class for people. At a very high level, if I were to take the 30,000 point of view, what are we really, really trying to do here? Is do our part, quite frankly, in collapsing that wealth gap between the rich and the poor, because currently only the very rich and the biggest institutions have access to this great asset class of venture funds, private equity, et cetera. And that's not fair. That shouldn't, and the problem is even today we have these archaic laws that prevent the typical retail investor to be able to access these great funds. And these laws, the accreditation law, for instance, we're talking about the Securities Act of 1933, the Securities Act of 1940. 1940, FDR was president. The biggest invention was Scotch tape. And yet some of our investing laws haven't changed, since then. They need to get modernized. There is no reason why a retail investor can lever up and buy as much, dog-related coin as they want to, but they can't invest in a low volatility, hedge fund. Like, it just makes absolutely no sense to me. And we want to just be able to do our part in trying to take this asset class to that retail community. But also, you know what? We have to make changes to the laws.
Yeah.
We got to eliminate this accreditation standard.
It's so much easier said than done. Yeah, I think the law change is going to be very difficult. It's going to be hard.
Yeah, and we're gonna be evangelists. We're gonna do our part. But it may take some time. And currently, just so that your audience knows, is that the accreditation rules dictates that basically only people who make a certain amount of money or have a certain amount of net worth can invest in these alternative funds. It's total bullshit, right? And we need to change those laws. The other thing is this, as it relates more, I guess, fundamentally to why people should have alts in their portfolios. It just gives them broadening their portfolio with some diversification. If you're just long, the S&P 500, you're just long a few stocks here and there. You're taking a lot of risk, right? Because you're likely going to have close to 100% correlation with the markets. And you don't have any downside protection. So it might be useful for somebody in that instance to have some, low net uncorrelated hedge funds on their in their portfolio, or maybe some yield vehicles in their portfolio, et cetera. So we want to offer all those types of alternatives to people.
Yeah, no, I really, really commend you for that. So let's back up a little bit and get to know you a little better. So you worked in the fund industry. I was listening to an earlier interview. Your first investment, I think, was Abercrombie and Fitch when you were a teenager, maybe, or something, and it was kind of your first exposure to investing. You kind of got interested in high school, and then you went to NYU and you did some, personal trading. You kind of learned a little more about investing or trading there. And let's fast forward. What your first job, I guess, was? You said a Citigroup in an interview, and it was like investment banking. And tell us about that kind of role a little bit, like your first job. Because a lot of people that kind of, I think, are our audience, some of them are in the financial and the nitty gritty of the financial industry even. And tell us what you learned from that, and then how you kind of transitioned to the buy side or the hedge fund industry, and what that was like, if you don't mind.
Yeah, and maybe to give people some context. So I've been involved in investing since I was a little kid and exposed to investing as a child, and for the reason is that I'm an immigrant from Taiwan. We came here when I was 3 years old, and my parents were teachers essentially, and they realized the American dream through investing. So they taught themselves how to invest in the stocks, in real estate, et cetera. And so I was exposed to it at a very young age. And so that when I was in high school, I was the president of the investment club, et cetera, and just, was heavily interested in investing. Now, right after I graduated from NYU with the undergrad business degree, I went to investment banking. That's a very typical path. That is not a crazy out of left field. No, everybody went into investment banking.
I remember. What year was that? What year did you graduate NYU?
2005. Yeah.
Okay. I remember.
So in 2005, I graduated from NYU and then went straight into the sort of analyst investment banking program at Citigroup. I was in a mergers and acquisitions group. It's a lot of hours. Great place to learn. Fundamentals, but really, what it was for me is it just taught me like resilience. You're working 20 hours a week. Without any sleep, and
20 a day,
like 100 hours a week, 20 hours a day.
Oh yeah, 20 hours a day. Sorry. I would have loved it was 20 hours a week. Yeah, 100 hours a week, that type of stuff, right? And so that taught me a lot about resilience and just work ethic in general, right? But obviously, my mind was somewhere else in the sense that I knew this was a stepping stone for me to get to the buy side, i.e., work at a hedge fund, right? That's what I ultimately wanted to do. And then after my investment banking program, I joined S.A.C. Capital, which is now called Point 72. And, here I'm in LA. Most people have no idea what a hedge fund is or what a hedge fund manager does, So the way I explain it, because it's an entertainment city here in Hollywood, is, okay, so there's a show on Showtime called Billions. That's actually based on who I used to work for and the place that I used to work at, Axe Capital was S.A.C. Capital, and then Bobby Axelrod is actually based on Steven Cohen. I've also been asked, so which one are you in the show? I'm like, well, isn't there an Asian dude in there? Like, that's probably me. Yeah.
Now,
so
how close do you say that Billion show was to, I mean, there's a lot of things that are obviously not real, but was there a lot of real stuff that they got right, you think?
So to be frank, I've only watched the first season.
Me too. The first season, then it got a little too crazy for me, but I watched the first season.
I've only watched the first season, but The Office is almost like an exact replica of the S.A.C.
Wow.
Like even down to how people dress with the vests. That was very popular. And just so you know, at S.A.C. Capital, it was known to be a very cutthroat place to work, right?
Yeah.
And it was and I enjoyed it just because it was a pure meritocracy. There wasn't any bureaucracy. If you're good at making money, you get more money to manage. If you're bad at making money, you just get fired. Okay.
Yeah.
I actually like that sort of cutthroat environment. And you always knew where you stand because you could see your P&L on a minute by minute basis, essentially. But I would say the similarities. Number one is I think they were able to capture that sort of cutthroat environment pretty accurately. At least how it was when I was there. It's probably changed, over the past decade or so.
Sure.
Even I remember. If you survive your first 3 months at S.A.C. Capital, you got one of the S.A.C. vests.
Okay.
And if so I fortunately got an S.A.C. vest, but the other guy that joined S.A.C. Around the same time, he unfortunately did not get an S.A.C. vest. But I think they were able to capture it pretty well. This focus on edge and how do you capture edge and
the
stuff
psychologist.
like
that was true too, right? The psychologist wasn't there.
Psychiatrist, yeah. So Wendy Rhodes, the psychiatrist on the show, was actually based on a real person at S.A.C. Capital, a man named Ari Kiev. And Ari Kiev was actually one of the people that hired me at S.A.C.
Oh, wow.
So very interesting. I mean, it was, I think, the only hedge fund at that point in time that actually employed full-time an in-house psychiatrist. And so why was a psychiatrist role? Well, the psychiatrist, Ari Kiev, before S.A.C., he was training athletes at, I think it was Harvard, and then Olympians and stuff like that, helping them achieve peak performance, essentially. Mm-hmm. And so taking those sort of same methods with traders at S.A.C. Capital, because what you found is that a lot of investors, a lot of traders at S.A.C., for instance, maybe when they started managing $50 million, they were able to produce good performance. But then once they got to $200 million or $300 million, their performance started to suffer, right? Because each position becomes a much larger position, and maybe their psychology starts to change a bit, so he tries to really, make sure that these traders have the right psychological, thoughts and stuff like that to perform at their peak, right? But he unfortunately passed away a bit ago, but he was certainly an inspiration for folks at the firm.
That's great. That's great. And Matt, you had a similar path, right? You did investment banking out of school for a while, and was it mergers and acquisitions, or what? You had long hours too, I'm sure, right?
Yeah, so I was not quite in the grind of like bulge bracket investment banking in Manhattan. I started at a valuation firm in Manhattan, then moved back to Michigan, and I was doing sell side M&A advisory, like a middle market boutique here. So still definitely like super long hours, 100-hour work weeks were kind of the norm. I remember my boss like yelling at me because I didn't get this job done, like this document done that was on Christmas. It's like I worked like all Christmas Eve day, and we were working on this confidential information memorandum, and I just like didn't do anything on Christmas. And he calls me, he's like, "Where's the document?" I'm like, "Well, it's I touched base with you like 11 on Christmas Eve. I thought there was another." Yeah. So it was probably not as intense as
Dude, I had
S.A.C.
a lot of horror stories. So I just remember because we were so damn sleep deprived. Like I would take breaks in the bathroom stall, close the door as if I was taking SHIT, and just like put my head down and take a nap, like literally sitting on a toilet, Because the problem is that if they caught you,
what are you talking about?
Yeah, exactly. exactly.
No, no,
And
I remember people doing that when they're overworked. Yeah, that's tough. That's grueling hours. So go on.
yeah,
Mike.
because the
Sorry.
problem was this. Because listen, I was a lowly analyst. I was the bottom of the pyramid, right? And we on our floor, the M&A floor. I remember there was a lounge room. So if you wanted to take a nap, or rest, you could go to the lounge room. But you never want to be seen going into the lounge room, because what that means is you have capacity to do more work. And that's the problem. The worst parts, and Matt, you may be familiar with this, is the Friday night staffing. You think you have the entire weekend to yourself, then you get staffed on a brand new project, and you got to build a 100-page pitch deck by the end of the weekend. Those were absolutely, oh my goodness, I just shiver when I think about that.
Yeah, I definitely got a few of those. I mean, there were some nights where I was like, all right, 7:30, I feel like I'm actually on top of my stuff, and then the managing director walks in, he's like, hey, I've got this pitch coming up in 2 days, why don't you research XYZ industry, whatever it was, and come up with a deck. And it's all right, that sounds easy, but that's a 30-hour project that he wants done in 48 hours. It's on top of everything else that you have on your plate.
There is a great book for folks in the audience who may want to enter the investment banking world called Monkey Business. It's a classic. It's a funny book, but it'll give you perfect insight to what it's like being an analyst at an investment bank. So
yeah, interesting. Yeah, my job my story is not I worked long hours at UBS Investment Bank on their infamous trading floor in Stamford, Connecticut, and I was in the operations, middle office. I wasn't doing reports. I was reconciling trade confirmations and spreadsheets and stuff, and you'd have to stay late Friday night because our Japanese clients had to fax the trade. They wouldn't do it electronically. You had to wait for the fax and then type it into this system for everyone or whatever. But you'd be there Friday night at 10 o'clock. There were only a few people in there and starving, and there's nothing delivering. And just go to
I remember, by the way, Emmet, I remember the UBS building, that huge trading floor, because the headquarters of S.A.C. are in Stanford as well. Not too far from UBS. So I would always, when I was driving to and from work, always pass by that UBS building. Did you live in Stanford as well, or?
Yeah, I lived in New Canaan near Stanford. Yeah.
Yep.
And at the time, and then I lived in Stanford later, around New York City, and then Stanford again later. But that trading floor was big at the time. It was the biggest trading floor in the world, or I don't know, for a few years.
It was. Yeah, I remember it was huge. It was huge. Yeah. I would say I spent I was at S.A.C. for 5 years. I spent the first 3 years living in Stanford, so I was in my early mid-20s. Probably not a good choice to live in Stanford as a single guy.
It wasn't the best. New York City was way better.
Yeah, and then the last couple of years of S.A.C., I decided to just move to New York and do the reverse commutes.
That's what I did. Yeah.
So.
Fun times. Yeah, fun time. But we would scrounge. We would go to the canteen, which was closed for many hours, but they had the extra jelly and peanut butter cups and saltines, and open them up, the saltine crackers and the 2 packages, and open them, make ourselves mini peanut butter sandwiches with because we had nothing else to eat, and you'd I don't know, it was just you work. In those days, you work 80, 100 hours a week doing such crappy work, and you work out your hourly wage, and it's probably less than if you were at McDonald's for 100 hours a week. But you're just punching your card, trying to get your resume up.
Yeah, exactly. I just remember Stanford, when I was living there, I was so lonely. Because there's nothing going on in Stanford, right? And so when I would go home, literally, I would eat 4 out of the 7 nights a week. I would eat lean cuisines. I would literally microwave tray food, right? And that was my life as a hedge fund manager at S.A.C. is freaking eating lean cuisine. And then I was at S.A.C. during the crisis, right? During the '08 crisis, and people were losing money left and right. We're heading into a fairly deep recession, and our portfolio was up because my specialty back then was actually in short selling. But that being said, I had no idea what the heck was going to go on with the firm and stuff like that. And so to cut costs, they used to have Subway's $5 footlongs, so I ate that a lot as well. The $5 footlongs during the recession.
Those were nice. I remember those. Yeah. So your specialty was short selling. Tell us a little bit about that. That's something Matt and I have explored and experimented with a little bit here and there. what do you think was like the top? What was your like? Did you look for small, tiny companies to short, or big companies, or what was your favorite ways to figure out how to short a company?
I'll start off by doing saying this. I've been shorting for a very long time, thousands and thousands of stocks that I've shorted in my career, and I used to teach short selling as well. The most important thing I learned about short selling, just for the audience, is don't do it unless you have to. It's just extraordinarily difficult. It is not the opposite of buying a stock because there's potential for unlimited losses. Imagine being short like David Einhorn was Tesla, from probably like $40 to $800. Like that's not a fun ride.
No.
Or shorting Netflix was a popular short back in the day, and so it's a very, very difficult thing. And, the way sort of I thought about short selling was, I preferred shorting for profit versus shorting to reduce volatility, right? So most hedge funds, a lot of hedge funds, they're required to operate at a certain level of net exposure, so i.e. if their mandate is if I have $100 worth of longs, I always have to have $70 worth of shorts, right? And by the way, those $70 worth of shorts, I may not like those shorts, but I need to. This is how I need to manage the portfolio, manage volatility and stuff like that. I prefer shorting when I actually had a good idea and only putting it in place when I thought I was going to make money on it, not for reducing volatility purposes, right? And mandated, right? And that's what I did at Cypress, for instance. So sometimes we would have 0 shorts at Cypress. Sometimes we would have 15 shorts if we had 15 good ideas. And generally, a few different buckets of the types of shorts I would look for. Number one is, just fundamentally flawed businesses that are secularly declining. Whether it's back in the day, some of these brick and mortar companies and stuff like that, when things were going digital. Number two would be catalyst-driven, event-driven shorts. So if I had a specific viewpoint that this company was going to massively blow up on earnings, I may short that specifically for that event and then cover it right after the event occurs, for instance. And I generally didn't like to short for the sole purpose of hedging. That wasn't what I like doing because it's basically just a drag on P&L. Doing things like that. So, and I managed to catch a few different companies that were serious frauds as well. But those are very, very difficult to find. 99% of the time, it's very difficult to find frauds. So.
Yeah, I remember, was it Bill Ackman, was maybe 10 years ago, had that incredibly detailed report on like Green Mountain coffee roasters, I think it was at the time. And it was like this 180-page report basically about how this company was a fraud and like they were going to like go under, and it was incredibly convincing. And there was like just the sheer amount of work that went into that. I was like, well, he's probably right, but like, no, they ended up not being a fraud, and that was a kind of a flawed thesis.
Well, this is the thing is generally, this is why shorting is difficult because and it's unnatural, right? You're betting against people, i.e. the management teams, who generally wake up each day to try to improve their company, or create value for their shareholders. And they have inside information. Bill Ackman, as great as he is, he doesn't have inside information, or at least he shouldn't have inside information, right? And so it's a very, very difficult thing to do. Obviously, Green Mountain eventually got bought out. Hopefully Bill was in short during that period of time. But listen, Bill is a phenomenal investor. I think he had a couple of things that were difficult. Herbalife was a notorious one where he battled against Carl Icahn, and I recommend everybody to Google the CNBC fight between. Bill Ackman and Carl Icahn, because I still remember to this day.
That was just a fun one to watch. It was like get a bag of popcorn and just like see that battle play out. That was
one instance where everybody on every single trading floor just literally ignored what was going on in the markets and were like, "What's going on here?" You got these two billionaires battling it out. One's a bull, one's a bear, and it was highly, highly entertaining, obviously, to say the least.
They wanted to jump through the bull line to strangle each other. You could tell it was like that.
Yeah. And then Herbalife was a huge campaign he did that obviously he was clearly wrong on. And then, and by the way, one thing that we did at S.A.C. was analyze the batting and slugging of traders on the trading floor. And what you realize is this: the very best traders and portfolio managers are right 55% of the time. So that's batting average. How much you're right versus how much you're wrong, right? So which means that even the best traders are wrong almost half the time.
Yeah.
And so what becomes more important than whether you're right or wrong on stock is the slugging. How much do you make when you're right versus how much you lose when you're wrong? And that a lot of that is the ability to cut losses when you know you're wrong versus letting an idea. If you've lost 20% on an idea, a lot of times you sort of anchor yourself to, I just want to get back to even or something like that. But the market doesn't care. The market doesn't know that you bought your stock here and now it's 20% less, and so people, it's psychologically difficult for a lot of people, including the best professionals, to do away with anchoring, for instance, right? And then it's also the ability to obviously let your winners ride and add to the winners. You guys have done phenomenally well with Tesla. It's a company that better than most other people in the world. And that allows you, the knowledge base that you guys have on that company allows you to effectively trade it, So
talking about Tesla a little bit, a lot of our, audience is huge Tesla fanatics like we are. And you said you're a self-proclaimed Tesla fan. And what I've noticed is a lot of like the traditional institutional Wall Street, primarily like on the East Coast, for whatever reason, they've had a hard time coming around to Tesla or late to the party to realize it. And, it's just been a hard pill to swallow for a lot of traditional, even, billion-dollar hedge fund managers in particular. There's a few outliers here and there, obviously, that have been bulls early on. But on the West Coast, there's a lot more embracing, maybe because we see the car around a lot or whatever. What do you think the difference is? Why is the mindset of the East Coast financial capital, why has it been so late to the party with Tesla, or so anti-Tesla for so long? Why do you think that is?
I think there's many different reasons, but one of them would be, listen, a lot of I don't know if it's most, but a lot of professional fund managers learn fundamental investing, right? So what does that mean? A lot of times, they learn under the strategy of buy, low valued stocks and short high valued stocks, and when they're looking about valuation, they're looking about what's the valuation today or tomorrow. Yeah. They're not looking like you are. Hey, what's the valuation going to look like based on numbers 5 years from now when there's a heck more and more Teslas on the world, and stuff like that, right? And so I think a lot of analysts have trouble valuing Tesla because they don't really know how to predict the future earnings of it, and so it looks expensive on today's metric, so they're going to short it, right? So that's one thing. It's just how a lot of these analysts were trained, Yeah.
And it gets drilled into them 100 hours a week, early on in their career, that type of valuation probably too. Right?
Yeah. And one thing I learned from hiring many analysts in the past is there's absolutely zero correlation between how smart you are and how good you are at making money with an investment. Literally zero, And in fact, I would say this, it's sometimes even detrimental. Some of the worst investors that I've come across have the most degrees. Harvard Business, and then they go to Goldman Sachs Investment Banking, yada, yada. And you think that, wow, these guys are really smart. But that sometimes works against you. And here's a very simple reason why. Is just that if you've gone to Harvard and you got a Harvard Business degree and maybe even a law degree to add to that, what have you done? You've actually been successful. You're very smart. You're used to accomplishing things and being successful at, taking exams and writing essays and stuff like that, where things are fairly well defined. From an output perspective. The problem with investing is that, in a nutshell, what we're trying to do as investors is predict a future. And the future is inherently unknowable. It's very, very difficult to predict the future, right? Which actually means that you're going to be wrong a lot of times. Like I said before, at S.A.C. Capital, 55% batting average was for the best investors out at S.A.C., which is a good microcosm for probably, the rest of the, investing environment as well. Which means, again, you're wrong. You're going to be wrong like half the time. And the problem with these super, super smart, accomplished people is like they can't accept that they're wrong. You know, they don't have intellectual honesty. And that is literally one of the most important things about investing. To me, it's 99% psychology, 1%, quantitative stuff, right? It's that psychology that really messes you up or works to your advantage if you're good at remaining calm and logical and stuff like that. And so I always found that, if I had an analyst from a very smart guy pitches an idea, sounds great, but then, they blew up on earnings. And I asked the analyst, well, what should we do now? What's going on? What's our game plan? A lot of times, if they're not intellectually honest, they'll have what we call thesis creep in the industry. They'll go, yeah, the earnings weren't good, but hey, it's very cheap now. We should double up, And that's a problem, right, for a lot of really, really smart people is they can't be intellectually honest and evaluate the situation as it currently stands in a very logical way because they're, number one, afraid of being wrong. They can't admit to themselves that they're wrong. And then two is if their compensation model, like many hedge funds, is based on their own direct P&L that they generate, a lot of times, they have no incentive to sell a position at a loss because that means they got to make it back another way, and those are sort of inherent disadvantages for many investors on Wall Street.
Yeah, it's so interesting because we kind of know these are the rules of the road, right? That you're going to be wrong a decent amount of the time, but yet I do find it interesting that not many people, at least that I hear speaking publicly, are kind of thinking about investing in probabilistic terms, and that's really the way that Emmet and I think a lot of some of our investments is. We're looking for really asymmetric opportunities, things that can go up 5 or 10x. But we know we're going to be wrong a decent amount of the time. And so that's one of the questions we're always, when Emmet and I are talking, privately a couple times a week, how's this doing? And has our thesis changed? And should we cut our losses, based on this latest development? So it's so interesting to me that that's what you saw at S.A.C. as well, that, there's just almost a sense of pride of, oh, I couldn't be wrong. The market's got to be wrong. Or I've got to double down now to make up for it. So I think you're absolutely right that's a skill set that more investors really would benefit from, just that intellectual honesty and recognizing that they're going to be wrong and kind of going back post-mortem on their decision making and say, okay, what did I get wrong, and has the investment thesis fundamentally changed, and if so, cut my losses.
Yeah, and that probabilistic framework is a very good framework. It's a framework that I used to use at Cypress as well. And for me, it was really having 3 scenarios for every stock that we evaluated, right? The bull case, the base case, and then the bear case, right? And each of them have their own price targets that we have. And so that helped us frame, all right, well, that helped us decide whether to buy more of a stock. So for instance, if it got close to the bear case, okay, so there's only 10% downside from here, we should be buying more, once it gets, at or above our bull case, we may decide, let's take some profits and stuff like that. So having that probabilistic framework, I think is a pretty good idea,
Yeah. So, Michael, you and I have something in common. I learned that's kind of unique. Both of us are young kids. First stock they bought was Roblox, and I heard that in a story that you were telling. And so, tell us a little bit about how you got your son. I mean, you're talking about expanding, democratizing information, all that to other audiences for alternative investment. But I think you've also talked about how important it is to teach younger people, finance and getting our kids started early and about investing. Mm-hmm. I mean, what's your son's thesis on Roblox stock? What do you think the future is? I'm curious.
I don't know if he has much of a thesis, but I could say this: is like my son.
A financial model.
Yeah, exactly. No, it's just buy. That's the motto. It's my son is 6 years old. I started talking to him about basics of financial literacy when he was probably 4 years old, and we bought Roblox last year when it became public. And basically, and I'm sure like your kids as well, Emmet, is my kids are literally on Roblox all day long. If they're not at school and they have access to their iPad, they're only on Roblox. And that's how they communicate with their friends. That's where they hang out. You know, it's not at the mall anymore. It's literally in the metaverse of Roblox. And I've spent thousands and thousands of dollars on Robux so that he can buy these virtual goods and stuff like that. You know, what was most frustrating for me, to be honest, was like he would spend, $100 worth of Robux building this huge theme park on Roller Coaster Tycoon, and then he would just tear it apart and start afresh. I'm like, and then ask for more Robux. I'm like, dude, like you could save that and just build on top of it. I mean, so that always drove me crazy, but it also told me, wow, this is a great business. I can't say no to my kids, and this is literally, they don't play with toys anymore. They play with Roblox. And so recognizing that, as I started talking about, hey, by the way, you can actually own a piece of this company that makes this game that you love so much. And then, how do you do it? Well, here, let me open up an account for you. I could buy, a share of Roblox at $50, right? So it means you own one share of Roblox, and you can monitor how that stock does and how much money you're making or losing each day. If it goes from $50 to $60, well, you've made $10. It goes from $50 to $40, you've lost $10. Now, for him, I always changed it what $10 meant in Robux terms, because he thinks only in Robux. He doesn't think in US dollars.
Yeah. You got to choose the translation, the FX translation.
Yeah. So I assume that's probably similar to your kids. And
absolutely, yeah. I have a funny story too. Like, my kids, they were all playing like this game called Superhero Tycoon one day. You might be, I don't know if you've heard that one, but you get these superpowers and you like build these factory things to get more superpowers, and it takes time, but you can skip the line and just like buy all the coolest superpowers with your Robux instead of having to work for it,
Yeah, exactly.
So I joined without them knowing. I went into the super tier. I ended up spending maybe $100 of Robux myself somehow on my account in like 5 minutes to get like all amped up on superpowers. And I like raided their little tycoon unit, and they were all like surprised, and it was a cool little experience to be like the dad that had all the superpowers going into their virtual world, and they were like, "Whoa, Dad's here! He's going to destroy our fort." It was a fun little exercise. But yeah, they spend money on Robux like crazy. As a grown up, I spent like $100 in like 10 minutes without realizing it, and it's an interesting business.
And
model.
By the way, to your point on a lot of people on Wall Street, I would imagine that they actually view Roblox more as a short, than a long. And again, a lot of times these people on Wall Street, they don't understand technology. Even folks that invest in the technology sector, like they don't go into Roblox and play around with it, or maybe they don't have kids, so they don't realize like how embedded into people's lives are that this game is, so they'll be like, well, this is expensive on this year's metrics, so I want to short it, etc. Blah blah blah.
Some of these things can take years to play out, as we saw with Tesla. Even though it seemed like the future to some of us pretty obvious, but a lot of people were shorting it. And from 2014 to 2019, it was just kind of range bound and suppressed, and then eventually the stock kind of blew up. So who knows? I mean, Roblox could be something similar. It could be range bound for years, or had a nice run earlier in the year, but all the tech and disruptive stocks have taken a beating. What's your view on the macro market kind of revaluation and all the tech and growth stocks in particular? I would say number one is because I'm building this fintech company, I've had less time to keep up with the markets as much as I used to. I mean, investing is a full-time job, as you guys know. So I always recommend people who have day jobs, whether they're doctors doing surgeries all day long or tech entrepreneurs, is allocate most of your capital with managers that do this on a daily basis, like you guys, for instance, right? So just put that out there. But I would say that this is a very tricky market, and this time in the market is tricky. And the reason why it's tricky is because, it's very clear that there's bad stuff going on out there. Obviously, everybody's
open up the Wall Street Journal, everything's about inflation and how prices are going up and blah, 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 all that stuff. Interest rates are going up and we're in a tightening cycle, And what makes it tricky is and just based on news flow alone, you'd be like, shit, I want to get out of the markets, But the offset to that is like some of these stocks are already down 50 to 70%. So it's already reflected this sort of bear case scenario as well. So, the difficult part is knowing exactly what's already baked in, right? Extraordinarily difficult environment right now to know exactly what's baked in. A stock that's down 50 to 60%, you may think, well, perhaps it's a good time to buy. And perhaps it is. And in many cases, it probably is. But at the same point in time, it's like, well, crap. Interest rates have just gone from 0 to 2%. In literally a straight line. What if it goes to 4 or 5%? What happens then? And probably more downside. So I would say this is it's very tricky. I would be out there, and all of it also ties back whether you want to buy or sell something. It ties back to your time frame. So if you have a long enough time frame, 1 year, 2 years, 5 years, 10 years, yeah. You should definitely be buying a lot of these assets that are great assets run by great management teams with big moats that are trading at trading half the value they were even 4 months ago. Like that's probably a good place to start looking. I'd probably stay away from some of the highly speculative stuff. A lot of these SPACs that came public with zero revenue, so they're pre-revenues. So they're just burning cash. I probably, even if they've come down a lot, there's still a lot of there's enough good companies that have devalued dramatically. Like, why bother going out the risk spectrum and trying to find crap? Like buy more Tesla or something like that, right? So,
yeah, I think that echoes our own thoughts. Almost to a T. It seems like everything's taken a beating, but there are definitely some kind of gems that were beat up, along with some companies that are probably not going to make it. So yeah, I'm curious with your background in shorts too. Were you active in shorting any of the SPACs that were kind of all the rage a year ago?
I did short a couple of them, and to be fully transparent, I do have my Interactive Brokers account with a number of names that I like names like Tesla and stuff like that. But I haven't been actively trading, and the reason is because I'm generally more longer term, and I just, I'm in meetings all day long, and running this tech company, so I just have less time to be able to actively trade, So
cool.
So maybe on that note, where is Prometheus these days, and the the product launch kind of life cycle in terms of the media side, and then also on the kind of like active investment side?
Sure. So the platform itself won't be launched for probably a couple more months until we build out the desktop app and we completely build out the marketplace. So we're probably a couple months away from launching more broadly. But that being said, people can come to our website, www.prometheusalts.com. and put their name on the wait list so that when we do launch, we'll get you an invite. But we are doing a lot of stuff on the content side and the media side. So we started with interviews with folks like yourselves on our podcasts. We'll cut up some of those interviews into bite-sized segments, and we'll TikTokize them, essentially animate this footage so that it's really fun and interesting to watch. And you can see some of that content on our socials, at Prometheus Alts. And we'll likely be doing docuseries next, doing a docuseries around different iconoclasts in the business and financial world and how they positively impacted their environments. Look to get started on that type of stuff on one or a couple of the different big streamers. And again, what we're doing on the media side is basically trying to become the new age Bloomberg, if you will, or the modern CNBC. CNBC's old world media, right? We're new world media with social, that community, the ability to engage directly with different managers, et cetera. And doing, financial content in a really cool, fun way, like this TikTok-tized type of content, So we're cranking on that. We have 3 podcasts, Prometheus Decoded, one called Currently, which focuses on current events. and then one called Blockchain Minute, where our in-house crypto expert really summarizes what's going on in the blockchain world in a handful of minutes. So check those things out, and stay tuned for a lot more content coming up.
Yeah, no, you guys really do a good job with the interviews. I've listened to a few of them on both the Prometheus Currently and the other Prometheus podcast. You have a couple channels there you mentioned. So yeah, no, thanks. I think your mission is a good one, and we're looking forward to see it expand and the official product launch, and hopefully playing a role in helping you guys grow over time. So yeah, I like what you're doing. Yeah, and usually at the end of we're getting close to the hour mark, so the last 5 minutes or so we usually are leave with the charitable. As you know, we donate $2,500 to a charity of choice of the person we're interviewing at this time, and you picked a charity. It's called the Georgie Badil Foundation. Is that the right pronunciation?
Yeah, the Georgie Badil Foundation. That's right. Yeah.
So tell us a little bit about that, if you don't mind. I looked it up. It looks really interesting.
Yeah. So so Georgia Bedell, she was a very prominent model. She grew up in an area in West Africa, and she was on our podcast, I believe, a week ago or so, and her story really resonated with me. So she described how when she grew up, and I think she was one of like 10 different kids. Every morning she'd have to wake up at 6 a.m. and walk 3 hours to get water, and walk 3 hours back to her village. And so we were talking about 6 hours a day of just walking to retrieve a basic necessity, water, and so, that was her growing up every single day. And then she went to Paris and had this modeling career. And when she went back to her village, it was still the same thing. Her sisters would have to wake up at early in the morning to fetch water and fetch it back, and they didn't have a real good sewage sanitation system and stuff like that. And so the Georgie Badel Foundation is really about bringing clean water to these areas where they don't have access to clean water. So this money will go towards building wells and also maintaining these wells as well, so that people there can have access to clean water and cleaner hygiene.
Wow.
So
that's great. No, I mean, I think that's very commendable, and it's amazing. We learn about some of these different causes, and you wonder, like, well, how is that still, something going on in the world? And that needs to be solved. And I bet $1 or $2,500 going towards this will do a lot of good. And so. Sometimes we only hear about issues in the United States and or in the Western world as we know it, that most of our investors are part of, but there's other parts of the world that are in dire need of not even modern day technology, just some type of technology to bring them into, a more livable situation.
Absolutely.
It's something we completely take for granted.
Yeah, absolutely. We in America, I mean, we are the luckiest people, and unfortunately some people don't realize that, but they haven't been to places like Africa or Cambodia and stuff like that. You see how other people live. So, we should be counting our blessings here if you live in America. So
yeah, absolutely. Well, Michael, thank you very much for being on our channel. We'll get that donation out right away, and we look forward to speaking with you again on Prometheus, or having you back on our channel one day in the future.
Absolutely. No, I love this. This is fantastic. And I think you guys are doing a great thing. I love that charitable aspect of it. And obviously, good. So, you guys are one of our launch partners. So really appreciate it.
Sure. Great. We're happy to be launch partners with you guys. So, all right, we'll leave it there and talk to you guys next time. All right.
Thanks, take care. Bye-bye.
All right.